Hello traders, welcome back to the Forex Geek channel where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we're going to be talking about the long line candlestick pattern, a crucial element in technical analysis that can significantly enhance your trading strategy. This pattern is known for its ability to reveal price sentiment and potential price movements, making it an essential tool for any serious trader. Stick around until the end of this video to learn how to effectively identify any trade using this pattern, ensuring you have the knowledge to make informed and profitable trading decisions. We start by understanding what the long line candlestick is all about, and this pattern is a fundamental component of technical analysis, providing insights into the market dynamics. This pattern is characterized by a single candlestick with long and minimal shadows, as seen in my diagram over here on the screen, indicating strong momentum in the direction of the candle body. As we can see here, means is have a strong momentum to the downside for this bearish candle, while for the bullish candle indicates that it has a strong momentum to the upside. And there are two types of this long line candlestick pattern: the long white candlestick, which is the bullish candlestick, and the long black candlestick, and which is the bearish. The long white candlestick, this pattern typically signifies strong bullish or buying pressure. It opens near the low and closes near the high of the period, suggesting that buyers are dominant this period or this section on the market. This is the bullish long line candlestick pattern, while the bearish long black candlestick pattern, which is the bearish pattern, indicates strong selling pressure, and it opens near the high and closes near the low of the period, suggesting that sellers were in control. And this is an example of the long black candlestick. Let's go to the chart and see if we can spot them. This is an example of a long white candlestick, while to spot a long bearish candlestick, we would go to this time frame. You can see a long black bearish candlestick. We can still see a long black bearish stick at this area of the market. Now let's see how we can trade the long line candlestick. Let's see how we can put this into trading. First of all, we have to identify the entry points. When you spot a large once you spot a large white candlestick, consider it a potential signal for entering long position, especially if it appears in an uptrend or near a support area. As we can see, this is a support region. This is a previous high in the market, suggesting price found it difficult to break this resistance. This shows that the pattern appeared at a resistance level that turned support when price came to this area. So this pattern further strengthens when we see it at a support or a resistance level. When it comes to a long bearish candlestick, when you spot this pattern in a strong support area, as we can see, this area price retested, broke, passed through, came here to consolidate, retested, could not break it, broke above it, broke back inside, and showed some rejection, showing this area is a strong resistance area. When we saw this long black candle at this area, it further confirms that this is a strong bearish trend. How do we enter near immediately when we see our long candle. This is when we enter our trade, and setting stop loss is very crucial. To manage our risk is crucial. Always set your stop loss order below the low of the long candle. If you are to enter this trade at the long candle, after the long candle, when we enter the trade at this area, you always put your stop loss below the low of the long candle. Then in terms of a short trade, you put your stop loss just above the high of the long bearish candle. This is how we enter the trade, and this is where we put our stop loss. Setting our stop loss is very crucial because it helps us protect the market, protects our trading position against unexpected market reversal. By also combining this, we can also further combine this strategy with indicators. We can combine it with indicators such as our RSI. If we combine this with our RSI, it further strengthens this position, showing that there is a strong case to be made in this area of the market. And as we can see, when price came to this area and we were trying to take the trade, market was showing signs of oversold, showing that the price will soon reverse to the upside because it was in an oversold, a sustained oversold region. Then if we look at this area in the market, it shows that price was in an overbought area in the market, which is above 60, showing that price will soon leave the overbought area to drop down because sellers are coming into the market. We can further strengthen this strategy with our volume. With the long bearish, with the long black candle, we see a strengthened volume, indicating that there was volatility in the market during this time of the day. Now we have to also monitor the market condition. We have to be aware of the broader market condition and news events that could impact price movement. This awareness ensures that your trade are aligned with the overall market sentiment. Now in these trading strategies, there are some common mistakes that we end up making, and we need to avoid them. By naming these mistakes we need to stop making, it further equips you for the mistakes and know how to avoid them. The first mistake is ignoring the market confirmation signal. We need to always trade when there is a confirmation. We should never enter a trade without confirmation. It is crucial and is one of the most frequent errors when taking this trade. Some people take the trade solely based on the appearance of the long line candlestick pattern without confirming from additional indicators. So we always need to confirm from additional indicators, be it your volume, be it your RSI, or be it your MACD. You can confirm it from these indicators. The second mistake we need to avoid making is overlooking market context. It is crucial to always consider the broader market context when interpreting this pattern. We have a long line candlestick may appear insignificant areas, but it could occur in a sideways moving market. When we see this pattern in a sideways moving market, we need to typically avoid taking a trade in that area. We need to always be sure that the market is in a trending phase before we take this position. The third mistake we need to avoid is neglecting support and resistance level. And as you can see, we took this trade from a strong support area when price found it difficult to break this area that turned to a support area when price broke above. And the selling area, we took it from a strong resistance area. We should always factor in support and resistance level to this area, because ignoring this critical area can result to poor entries and exit points. The fourth and last mistake we need to avoid making is over trading, because we spot this pattern frequently and this can lead to over trading. We are always spotting this pattern in our day-to-day trading lifestyle. So we need to always Remember that it's not in every market condition that these patterns are reliable. It is essential to be selective and patient when waiting for a high probability trading setup. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like and subscribe. Turn on your notification bell so that you wouldn't miss out on more trading tips and strategies. Thank you for watching, and I will see you in the next video.